Sarah's set the scene really nicely there. We have seen a massive surge in private equity, in deals, in money being deployed. But as she said, we are hitting something of a sandbank. I've got 30 minutes on the clock. We are going to have a very realistic conversation about where we are now, how things need to change, where we're going next. Let's start with where we are now. Andrea, I'm just going to pick on you first because I want you to give me the landscape that we are in today with private equity.
Well, private equity, we just come off a phenomenal decade. And when you come off of a great decade for private equity, people get a little bit loose, if you want. So the last few deals obviously are too much. We raised too much money, and the industry is having a moment. And it's diverging. There is the winners and the losers, and it's very clear, if you want, what needs to be done for this industry to evolve to the next stage, and then have another good wave, which I think is operational improvement. It's what is dividing the winning firms and the firms which are having a moment. They will reorganize, but there will be a moment before that happens.
Okay, I want to ask how private equity needs to change. We've heard a lot about innovation over the last 36 hours. What needs to happen next? Anyone? Rishi?
Oh, okay. So listen, like pretty much everything else in life, private equity as an asset class, as an industry, is evolving, and it is evolving in two ways. One is that it is going deeper into specialization, and the second is that it is embracing, the external stimuli that is being provided to us by all of the technical innovation that is happening all around us. So how is private equity going to change from here? I would say two things. One is domain expertise is going to become a much bigger driver of excess returns and alpha within private equity going forward than it has been historically in the past. And the second is the use of modern digital tools, in particular AI, is going to become an important element of the entire value chain of private equity, from origination to ongoing management to increasing the value of portfolio companies, and obviously all the way through to monetization.
Okay, David, Bain, one of the biggest names. What does evolution need to look like? What does innovation need to look like right now?
So I agree with the framing, which is that private equity in some ways needs to get back to the basics of driving operational value. We've had a lot of macroeconomic pressures. The industry did get a bit ahead of itself in terms of the kind of 2021 period when there was a big peak. But in many ways, I look at it as finding ways to bring new capabilities to this question of value creation. A big piece of this, in our view, is being global. We see very similar big thematic trends that are occurring across geography. And so the ability to have that lens to see these early technology trends in the United States, then come to Europe and Asia. Other big trends we see in aviation defense is something that countries around the world are focused on. There are a lot of learnings that you can take, share these best practices to help get you a little bit ahead of the curve in investing in different geographies. The second piece is really this operational value creation. I think we used to be generalists in going and supporting our companies. Now we have big, deep teams with people with significant specialist capabilities that can help reorient supply chains that may now have to move from Asia to the West, to help set up domestic manufacturing facilities that are best in class, that leverage automation and robotics and the like. Really just a different level of specialist capability that you need to bring to bear that has to do with having teams of people that can jump in a lot of these areas of expertise. I think that's kind of where the industry has to go. We have to become domain experts that have big corporate capabilities that can support our companies.
Do we, Andrea, or do we just need to get back to basics?
I think the industry does it well in some cases. The basics are that ultimately, we invest through cycles. We're long-term investors. If we choose the right industries, there might be a point in the cycle where you have to kind of hunker down, but you want to participate in the long-term growth. And so really it's about driving operational value through the cycle. And that's always been the challenge of private equity. I think it's just, there are more variables that we have to contend with as we take on much larger investments that, you know, the companies themselves are global. They have technology trends that they need to adapt to. And so it's just really more disciplines that you need to master. But I think it is really the same core opportunity for us.
Khaled, you're nodding. What's the Abu Dhabi, what's the Alpha Dhabi view on that?
Well, Brandy, as you know, Alpha Dhabi, we're platform builders here. We're relatively young concern compared to our peers here, but we've been growing phenomenally in the last few years, basically building platforms, taking advantage of the step change that has fallen upon the UAE in terms of regulatory changes, FDI, population increase, and then obviously in our core sectors, real estate, construction, infrastructure, a significant inflow of capital into our region that allows us to not just monetize some of our positions, but also reinvest with strategic partners and create long-term value for our shareholders in key sectors where we operate.
Has PE got away from some of those basics? I've heard a lot of phrases over the last day and a half. At ADFW, people are talking about long-term partnerships, people are talking about aligned capital, building strong platforms, in it for the long-term relationships, not just being transactional, da-da-da-da-da. What does it actually mean in practice? It sounds like the words that you write on a press release. How do you do it in real life, and are we doing it in real life?
The successful firms do it. I mean, for instance, in our case, we do 2 transactions a month as add-ons. The world is becoming complicated. You need relationships. You need to understand the US. You need to understand geopolitics. You need to understand globalization. You need 9 offices to support a successful companies like we do. So it's a completely different world. If I go back 30 years, you could have a deal team, and you were smart if you did a deal. Today, you need a very large operation improvement team. You need, knowledge of global markets and people on the ground. It is very, very complex. So the firms have grown from, 10 to 20 people to hundreds. In our case, we're 250. It's a completely different environment than it used to be if you want to build a company. And in a world which is becoming consistently more difficult, you must not so much guess where the world is going, but you must be very fast at reacting. So the teams are different. The way you address issues are different. You cannot predict the issues that come out, but you can move very, very quickly. And the important thing in private equity, when you mentioned before going back to basics, private equity was created to be faster, smarter than what the environment gave to you. In good old days, if you are a smart deal doer, that was enough. Now you have to have a smart deal doer, have a machine, have a culture, and have the capital also, because you mentioned permanent capital or external capital to do it. It's a complete new world.
Do we have a mic that works for?
Can you hear me?
Yep.
So if I can add then to your point, Andrea, for us, the capital allows us to be very flexible in creating and ideating new platforms and new ideas, which we've done very successfully over the last 4 years. We've actually seeded and or combined 4 platforms. We actually announced today the expansion of one of them, which was the private credit JV with Mubadala. Just closed an acquisition that increases its AUMs from 1.1 to 1.7 billion, just announced a few minutes ago. And that is an idea of taking advantage of the trends. And that's across asset classes, not just on the private equity side. On the F&B side, we took advantage again and seeded and bought and built several brands. And that is, again, with the expectation of one day potentially listing this business. And lastly, we tied up with ADNOC Drilling about 2 years ago. Actually, we started this investment theme by going contrarian to oil and gas. Everyone was talking to ESG while oil was going to peak, and we took the opposite view. Abu Dhabi has the cheapest, cleanest barrel of oil on the planet, and we were going to be long oil and gas. So we bought 2 companies, convinced ADNOC to join hands, and now Enersol has now deployed $700 million out of the $1.5 billion committed capital. We look forward to grow that with our partners. And again, long-term, fungible, nimble money, but with a strategic purpose.
That's exactly what I was saying. Permanent capital did not exist 30 years ago. And smart permanent capital definitely didn't exist. Now with permanent capital, as a partner, as a counterpart sometimes, it's a whole new world.
Rishi?
No, I was going to go back also to the reference that you made earlier to platforms, right? So the word platform means different things to different people. Within private equity, it actually think of it more in the context of laying down the strongest possible foundation that you can with an investee company so that you give it all of the levers that it needs to grow organically as well as inorganically into adjacencies, into new markets, into its core business, whatever the case might be. But the starting point always is identifying the right markets, first of all, right, that are business friendly. For instance, the region is increasingly attractive now for deployment of investment capital. Within those right markets, the right sectors, the industries that have a secular long-term tailwind, we are not traders. We are not even 5-year cycles. We think in terms of 10, 15 years. And then behind those industries, identifying the right companies with the right management teams that have what it takes to deliver that expansion journey, right? Now, the whole idea of permanent capital or temporary capital, again, is a little, kind of binary almost. What we really need is to match the duration of the capital to the value creation cycle of the underlying asset, right? Whether it is done through a fund that has a longer life horizon to it, whether it's done in an evergreen structure, whether it's done on a deal-by-deal basis, as we do at InvestCorp, that's up to to individual providers and individual investors. But I think the whole model of private equity is about capturing the long-term illiquidity premium that invests in private markets. And to capture that, we should give ourselves all of the flexibility that is needed to deliver that alpha.
Someone mentioned AI earlier. I can't remember who. I don't think I've had a conversation this week that hasn't had the AI question in there. And it comes from 2 angles. How is AI changing how you're working? And how is it changing the value that you are taking out of the assets that you are backing?
Can I say one thing? The 2 are the same. My job is to create value in the assets that I invest into. So, I kind of combine them into one thing. And the feedback loop of AI within private investing in particular starts all the way back to the sourcing engine. The better you are at identifying attractive investment opportunities in a proactive manner, well in advance of when they come to the market. If you're responding to a book that's been sent to you by a banker, you're already behind, right? You have to have known the assets that you want to track and invest behind, and AI can help you with that. The better you are at modeling out what the likely trajectory of this asset is going forward, AI will help you with that. The better you are enabling the underlying company and the management teams of the company to improve their go-to-market strategy, their sales effort, their productivity and efficiency, the better value creation opportunities that will exist. So it's all along the value chain, and it's an enabler.
David, you're quiet. Stop being quiet.
Thank you. I was going to pick up on your point and why this has been such a hot topic this year. I think 2025 was an inflection point. Clearly, there was all this, capital spend into data centers and the technology infrastructure, which has been significant and is ongoing. But I think this was the year when you started to see real adoption and significant productivity increase in companies that are using AI. We see it just within our own firm. We're a very data and knowledge intensive business. that invest behind years of cumulative experience, invest behind pattern recognition. And so the ability to leverage AI to help us look objectively and much more quickly at data patterns so we can arrive at better decisions is critical. There's not one business process within our organization that we're not taking a look at and saying, how can we deploy this technology to make it more efficient or to get our team members focused on the more value-added aspects of work. And that's exactly the parallel for what we see in our companies, which is this is really 25 is the first year we're seeing enterprise-wide implementations of AI. It's starting in the more manual intensive businesses that have a lot of repeated processes, but they're not already captured in some type of software system. And you're seeing enormous productivity leaps, not the typical incremental 5-10%, but 50, 60, 70% that have the potential to change business models. I think that's the less talked about aspect of AI. A lot of attention on hyperscalers and big capital going into AI, which is critical. But it's really this productivity surge that's going to be the thing that just justifies the ROI. And I think will change private equity in the next 5 to 10 years because it will be the primary tool of driving transformations at companies. But it will also make investing trickier because now you're trying to take a call on the pace of adoption of this technology, how it's going to change business and pricing models, who's going to be the winner and loser in that. I think that can be good if you can get advanced views of those technologies, but it could also set up much greater dispersion as technology comes into the more established industries that we're used to investing in.
Khaled, what AI-related discussions are you having internally and externally at the moment?
Well, Brandy, I think it impacts multiple angles. From us at the holding level, obviously, deal cycles will shorten, obviously with the technological improvements across diligence and execution, obviously on the legal documentation side as well. But mostly, I think the value will come from the portfolio management. And that is going to be critical. As Alpha Dhabi, we have in excess of 95,000 people working for the group, extended to probably closer to 200,000 people, if you include the wider associates and joint ventures. So there's significant automation and value to be created from AI to really drive cost synergies and EBITDA uplift. And the way we look at it is not just going to be AI, but also robotics. And that's going to be the next trend that comes as we look to potentially replace humans with, longer term investments. So you move from OPEX to CAPEX. And we're seeing not 2 to 3 years from now, the equation will be very compelling for large businesses. As you know, we have a very large construction empire, and that's going to be significantly disrupted with robotics as well as AI. So we're open. We're looking out to innovate across all our portfolio companies to drive real EBITDA uplift and value to our shareholders.
What does risk look like now with all the change that we've discussed on this panel? If we look at the deal that everyone's been talking about in the last 24 hours, if we take Warner Brothers, Paramount, Netflix, we've got a potential hostile takeover. We have a president that's getting involved. We have a president's son-in-law whose name is on some of the money there. We potentially have some golf money that is involved there. We have antitrust, regulatory, streaming, technology, all of it in one basket. I mean, it is a Netflix series ready to be made in itself. What does that tell us? What does that teach us about where we are at the moment and the way that we need to look at all of these factors differently, that we need to evaluate risk maybe differently? Andrea.
We're looking at complexity increasing in every transaction, whether how you finance the deals, how you operate the deals, how the geopolitics are involved in deals. The example you gave has almost everything. And the last turns have not been played out yet. So it's a world where you need a multifaceted ability to deal with risk. Some of the risk you can't predict. So it reunited also with AI. all the data predicting if the Houthis do this, if the Houthis do that, if the supply chain does this, the supply chain does that. That amount of data and amount of risk requires, apart from intelligent large teams, requires AI. You cannot predict all the permutation of a deal. And we're talking about, a lot of people. You mentioned scale. Everybody on this side has hundreds of thousands of employees directly or indirectly. So we have also responsibility, which then encompasses ESG, behavioral patterns, investors, etc. So it's a complex world, and the winners of tomorrow are organized to deal with this. And you cannot replicate it. You cannot build it in a minute. Every crisis you learn something. So there's a lot of risk out there.
And I think just to pick on that, that is precise because of this complexity. That's precisely where the need for domain expertise becomes so much more needed and transparent, right? Because including political complexity, right? So there are some players within private equity that have genuine domain expertise in navigating political, geopolitical complexity. That's their expertise. All the more power to them. That's not our expertise. Our expertise lies much more in understanding, what are the levers that we can pull to help a company grow into adjacent markets and new products. And, we lean on that.
I think, some context around what you mentioned is really old economy meeting new economy, certainly in the case of Netflix, Warner Music. And that's always been an industry where there's been political interest in terms of who's controlling the content. But if you look at what's happening in the pharmaceutical landscape, tremendous amount of M&A that's happening between large-scale pharma companies and biotech consolidating. You're going to see this with the data center, landscape now in the United States. There's more capital going into data center construction to house machines than there is capital going into commercial real estate to house humans who are working. And so this clash of new economy and old economy is still in early innings, and I think it's going to shape big, large-scale M&A. It's going to ultimately have impact in the businesses that we invest in, and this is, the latest, I think, dramatic example.
Khaled, complexity?
Well, I mean, every single transaction we look at is extremely complex just because of who we are and where we sit. Mm-hmm. And the fact that Abu Dhabi and we invest, and obviously Alpha Dhabi is a co-investor with ADNOC, Mubadala, ADQ. So our partners themselves are very complex as government, owned entities. So antitrust is a very interesting adventure every time we embark on a transaction, and especially in this complex environment now that we face in terms of the polarization of the different geographies where we invest. So if you look at it the other way, the UAE has entered into several comprehensive economic partnerships agreements. And these are avenues for us as an UAE-based firm to choose where we invest and how we invest as well, to take advantage of the ever-shifting landscape with respect to the tariffs and the economies around us. So we're always looking at that very dynamically. And as you know, we're very nimble and agile as a firm and are able to pivot quite quickly.
I've got 1 minute left for each of you, and I'm very scared of what happens if we don't stick to time. We have been warned. Give me your outlook for 2026 and how it's going to shape your strategy. Let's move down the line.
I think 2026 will be an acceleration of global buy and build and complex transactions.
You can have 30 seconds more if you want to tell me what you're going to do with that.
And Abu Dhabi will play an important part as being in the middle of the two sides of this. So many people are putting real deal teams here, like us.
Okay.
I think it'll be a good year from an economic setup perspective. I think you have a lot of interesting tailwinds that are driving global growth. And so we're probably a bit more optimistic, but I think you will start to see this impact of dislocation from AI. It's going to disrupt what we thought to be stable industries. You're going to see some aspects of labor dislocation that we'll all have to look at and kind of deal with. And Khalil mentioned some aspects of that before. And so we're going to see the beginning of what's, I think, a 10-year technology cycle that's going to have tremendous impact to the global economy.
And how's that going to impact what you do?
We all have to think from our technology lens, whether we're technologists or not. Technology is not a vertical. It's something that is going to impact all industries and all geographies. And I think we're all going to have to really step up our game in terms of our literacy and our capabilities in terms of adapting and deploying the technology.
Rishi, the Investcorp outlook?
Yeah, so I'm going to nuance my view and split it across markets and asset classes. So within private equity and focusing on North America, I think it's a relatively constructive backdrop. We should see an improved exit environment, a greater churn of capital, recycling of proceeds back from LPs, because the underlying economic backdrop is relatively constructive. In particular, supported by an expectation of some continued reduction in interest rates, which kind of leads me to the next asset class, which is real estate. We see it as an inflection point. Real estate has been a little under the weather of late, mainly because of the higher interest rate environment. As interest rates stabilize close to neutral and are expected to stay stable for the longer run, real estate, particularly in the US, but developed markets, should bounce back. Credit is a relatively constructive environment as well, as with 3%, 3.5% base rates, you're earning high single digits. In terms of markets, we see a particular emphasis on the corridor that is now clearly getting established between Asia, including the economies in Japan, Southeast Asia, China, India, and the Middle East. And we see that corridor becoming much more significant in the coming year, both in terms of sourcing of capital, but also in terms of deployment of capital, because there are growth engines, long-term demographic supportive engines, backing those up. And last but not least, I think there is an element of Europe is oversold, and there is some merit to the idea that American exceptionalism that persisted in the last decade will now slowly diversify to a more global base.
I'll take the Abu Dhabi angle since I'm going last. For us, obviously, you've seen the announcement yesterday from Aldar, the 60 billion expansion of Marriott Island.
Mm-hmm.
We see real estate that's continuing to have significant tailwinds behind it. Our construction assets are still benefiting from very solid backlogs that are continuing to rise. And as such, I think from a UAE and Abu Dhabi perspective, we're seeing real estate infrastructure, especially now as well with AI and Stargate and all the digital infrastructure coming into play, being very buoyant for all our businesses. The only, I would say, headwind going into 2026 is what happens to oil prices. And as it relates to the impact on our businesses, specifically the ones that have peripheral exposure to Saudi Arabia, and how we can both take advantage of these opportunities by, again, pivoting or being a little bit more prudent with our deployment in those sectors. But generally very positive on the outlook for the UAE and the region.
Yeah, thank you for that. That's one of the first mentions I've heard in anything I've been involved in of the oil price. But you're right, we're below 60 for WTI, and it does still matter. Gentlemen, thank you very much. Andrea, David, Rishi, Khaled, fast talking, so much information. Appreciate your time.